stock price of ICICI Lombard is actually holding out quite well despite the fact that it was a bit of a miss in Q3. Let's connect with Gopal Balachandran, who is the CFO and Chief Risk Officer at ICICI Lombard, joining in. Thanks so much for taking time out. To begin with, the motor segment, that has seen quite healthy growth, and that's largely been aided by strong two-wheeler, private vehicle and two-wheeler sales. What's your outlook? Will this sustain?
So I think that's a good question to start off with. I think as you rightly mentioned, I think if you look at the market environment in the context of auto vehicle sales, across segments, I think we have seen a lot of positive momentum getting played out. For example, which is what we had put out even as a part of our analyst call that we had last evening. If you look at it on the private car side, for example, I think we have seen almost close to about 3 million vehicles getting sold. On two-wheeler, we have seen for the market almost close to about 13 million vehicles getting sold, and on the commercial vehicle side, almost more than 1 million plus vehicles getting sold. So in that sense, I think the market momentum seems to be very, very positive. Which in that backdrop is where when you look at it in the context of ICICI Lombard for us, even for us, I think the growth momentum has been quite positive. And in fact, for the month of December, we have actually kind of gained market share. The industry grew at about 8.8% in overall motor. Our growth in motor was almost about 10.8%. And therefore, when we look at heading into Q4, I think we are very, very positive in terms of the opportunity that the segment presents. And we have got all the right levers in terms of distribution, service, and technology, which should aid us to kind of sustain the momentum that one is seeing in the context of motor.
You mentioned that you've been losing market share until December 2023. You have indicated early signs of that easing out. Will you be able to gain market share going forward? How much and how would pricing actually pan out also for you going forward?
So again, I think we'll have to put that into context. So the thought process of what ICICI Lombard historically has been to kind of drive profitable growth as a theme. And whenever we have seen elevated levels of competition play out in the market, we have always been taking a bit guarded/cautious approach to writing risks. Which is why in the last couple of years, when motor as a segment had seen elevated levels of competitive intensity getting played out, we obviously calibrated growth, and that's the reason why we have been a bit lower than insofar as market growth is concerned. If you look at the industry numbers, which is available obviously at a quarter's lag, the first half year numbers, reported numbers for the overall market seems to indicate possibly anywhere between 4 to 6% improvement in the loss ratios of motor as a category. So hence, to that sense, there seems to be some early signs of easing. And it is in that context is where I kind of talked about to say that we are very, very positive in terms of the outlook that one is seeing in the context of driving motor in terms of its growth. And while you will see in the aggregate for us, possibly, as I mentioned, maybe a lower than market growth, but the relative difference between industry growth and ICICI Lombard has been coming down every quarter. But as I said, for the month of December, we have actually been able to grow faster than the market. On the loss ratios, I think it could be a combination of either pricing getting better, or for the matter of fact, I think the relative cost of acquisition that one incurs in the context of the expense of management guidelines is something also which players in the market will have to calibrate. So those are 2 points that one will kind of watch for. As of now, early signs, but obviously we will watch for the trends to play out. But the momentum, as I mentioned earlier, looks to be very, very positive.
Okay, and tell us a little bit more about the health segment. Growth was a little slower in retail health. Is that a conscious effort? Any targets you have in mind?
I think so. Let me put the numbers in context. I think you're absolutely right. When you look at health as a category, that's been again a preferred one. Whether you look at the corporate health or whether you look at the retail health in terms of both the segments on the health side. If you see on a 9-month basis, the industry grew at roughly about 21-22%. Our growth has been slightly in excess of 29%. So we have had a significant outperformance in terms of growth. And even in the Q3, for example, the industry grew maybe slightly lower at about 15%. Our growth has been in excess of 24%. So we have always had a significant outperformance in the overall health portfolio. And within that, your point on us growing, let's say, relatively faster on corporate health in the context of retail, I think again, when you look at in terms of the market opportunity, both of the segments are preferred segments for us. We have definitely seen improvements in pricing getting played out on the corporate health side as we speak. And therefore, we have been kind of rightfully capturing the opportunity of growth in that segment. Retail health for us is an area of investment. We have not been actively investing in the past, but over the last couple of years, we have been significantly making the right investments in building distribution. And that's the reason why relatively the growth for us has been slightly lower. But it is pretty much, if you look at even retail health as a category, we grew slightly in excess of 19% on a 9-month basis. The industry numbers would have been slightly lower than 19%. So in that sense, we are actually trying to grow faster than the market. But that's an area where I said we are continuing to make investments in expanding distribution, equally significantly kind of excelling service capability and creating the right product portfolio. So hence, one would continue to see the momentum play out both on corporate health and retail health, as both of them are preferred segments of opportunities.
Right. And how do you see your net loss ratios play out in the motor as well as the health space? And how comfortable are you on risk?
In the context of our own experiences on motor loss ratios, again, it is within the range that we are comfortable with. Motor as a segment has got two sub-segments, motor own damage and motor third party. If you look at reported numbers for 9 months, motor own damage loss ratios were roughly at about 65%, and almost a similar number is what we had seen on the third party side. The range that we are comfortable with operating on motor loss ratios on own damage, for example, is between 60 to 65%. And on third party, we are comfortable operating at a range of 65 to 70%. So the overall book should operate at anywhere between 65 to 67. So in that sense, I think we are quite comfortable within the range at which we are operating at. And also, I think we end up doing a lot more in the context of claims management. That's an area of focus that we significantly focus on. And hence, to that extent is where I think we are comfortable with operating in the range of 65 to 67% in motor as a category, insofar as the loss experience is concerned. On the health side, I think the loss ratios could vary depending on whether you are making your offerings to a corporate or whether you're making your offerings to a retail customer. On the corporate side, I think even in the past, when we have kind of spoken to the channel, we have talked about the loss ratios on the corporate health side in the range of 94-95%. And even if you would have looked at the 9-month numbers reported for us, the number has been at about 95%. On retail health indemnity, we have talked about us being comfortable in the range of 65 to 70%. And for the 9 months, the retail health loss ratios has been around 66% or thereabout. So on both the segments, I think given the opportunity that one is seeing in terms of the positive momentum on growth, but equally given the focus that we have in terms of the loss management or claim service capability that we are creating, I think we are quite comfortable with the loss ratio ranges that we are operating at.
Combined ratio is at 103, almost 104. This is much better than what the street was penciling in. Could you reach a number of 102 earlier than what you had guided for?
I think it's again a great question. So I think this has to be again looked at in the context of the market. So if you look at just to kind of refresh, market numbers are always at a quarter's lag. The industry combined ratios for the overall industry is at about 112%. It is in that context is where you see ICICI Lombard's combined ratios at about 103.6%, let's say for Q3. Obviously, if the market improves, the ability of ICICI Lombard to obviously exhibit a better outcome is always there. And that's something that we actively look at and work towards directional change insofar as improvement in combined ratios are concerned. Even the reported combined that you see, whether it is for Q3 or whether it is for 9 months, this year, relative to what we have seen as catastrophic events play out in the previous year, we have had pretty much a cat event or a flood event in every quarter, which is why we also put out separately the impact that we have seen on account of flood losses. So for the 9 months, we had an impact on floods of almost close to about 1.37 billion rupees, as compared to, let's say, just about 28 crores impact that we had seen in the 9 months last year. So even if you were to kind of factor that out, the combined ratios would have been much better at even 102.3% as against 103.6% for the quarter. But your point on, can we look at, let's say, accelerating the thought process that we have put out to the market of getting to a combined of 102% by the end of FY25? As of now, I think we are sticking to that number. But obviously, I think we will come back maybe in a quarter or two, depending on how we see the market environment play out. Definitely, we will not let any of the opportunity lose, whether it is in terms of growth in revenues or, for the matter of fact, the improvement in combined ratios or profitability that we can exhibit for the company as a whole.
All right. And could you walk us through and tell us some of the details of the new product launches, any particular segments that you target?
Home insurance will be clearly a significant area of opportunity that one sees in the context of driving growth. If you look at globally, liability insurances play a very, very critical role, and they kind of contribute to a very large proportion of the property and the casualty market. In the Indian market, again, what we're getting to see is a lot more digitization and technology initiatives play out. In that context is where you also possibly get to see a lot of risks resulting from the digital transformation that we're doing as a country as a whole. So therefore, to that extent, you may possibly get to see some of the liability insurances, cyber liability, for example, could be an emerging product that could again see a huge prospect in terms of the opportunity that one is exhibiting. On health, I think we are continuously kind of working on improving the entire product stream to make sure that we have a product that kind of largely caters to different customer requirements. It could be either in terms of the various age groups, it could be in terms of the lifestyle that one leads, etc., etc. And therefore, continuously something you may get to see us coming back to the market and informing from time to time in terms of some of the new products that we want to launch in the context of the health offering as well. On motor, I think what we did maybe last year was we kind of introduced almost about 3 offerings, which was primarily to kind of say that you can pay based on the distance or the miles that you're driving in terms of the premiums that you pay, unlike a standard premium that you pay for a 1-year risk. So here you kind of pay for the distance of travel that you do, and correspondingly you pay a motor premium at corresponding to that. Or you could pay a premium based on your driving scores or driving attributes. So that's basically a pay as you drive. And finally, we also kind of launched what we call as motor on floater. Many a times you get to see a customer having more than one asset. So a motor on floater helps you to kind of combine both individual offerings into one single insurance policy. And in the process, it stands beneficial for the customer.
Right. So IFRS norms will be implemented from FY26 onwards, right? Do you expect to see an improvement in profitability on account of this?
We are in the midst of kind of doing the financial impact assessment of what would it entail insofar as transitioning to IFRS is concerned. But broadly, what I can talk about is there are 2-3 key changes that one is likely to see when you move to IFRS. One is in the context of the acquisition costs that you incur. Under the current Indian GAAP guidelines, all costs that you incur for sourcing of a premium or a sourcing of a risk, they get expensed out immediately. Whereas in the context of Ind AS or IFRS, your acquisition costs will be allowed to be amortized over the contract period. So hence, in that sense, that's a positive in the context of if you were to look at it vis-a-vis the current Indian GAAP guidelines. The second element is some of the on the claim side, there are certain lines of businesses where the development of claims or development of losses happen over a very long period of time. So, for example, motor third party. Now, there again, while you're required to pay for a claim over a longer period, but under the Indian GAAP guidelines, you are required to provide for reserves on a nominal basis. You are not allowed to do any discounting of reserves. As you transition to IFRS or Ind AS form of reporting, you may be allowed to discount those reserves as well, particularly for the segments which have a very, very long tail of claim development. So that's again positive if you look at it in the context of relative to the Indian GAAP guidelines. And the third is in the context of investments, where currently the Indian GAAP guidelines do not require us to do a mark-to-market insofar as the P&L is concerned, whether it is for the equity portfolio or whether it is for the debt debt portfolio that we have. So hence, in that sense, there is no mark-to-market impact. Any profit or loss gets reflected only on actual realization of sale of those securities. Insofar as Ind AS or IFRS is concerned, we will be subject to mark-to-market on the investment portfolio. Hence, to that extent, we may have to come back to the market every quarter and explain the performance impact, if any, consequent to the mark-to-market that goes through the P&L earnings.
All right, thanks so much for taking time out. Good to have you on board. That's the word coming in from the management of ICICI Lombard. Positive momentum across the board. Price improvement as well is playing out, and they have started investments in retail health.